current event we're discussing today relates to how the RBI is getting more and more foreign currency into the country in order to meet the demand for dollars. And the demand is to be contextualized in the current situation where you have geopolitical, geo-economic pressures. But we need to start with the basics. What are foreign currency reserves? What is Forex? Why do we need it? How do we get it? And what is the RBI doing to enable the country's resilience on the external front? Let's get to the basics first. What is foreign currency? Oh, that's so very simple. Our currency is domestic currency. The currencies of all other countries are foreign currencies. But foreign currencies in the global economic system, global financial system, largely refer to hard currencies. That is the currencies which are in demand. American dollar, British pound, Japanese yen, Chinese yuan, Swiss franc, and so on. These are the currencies in which the global economic system operates. You export, you would like to be paid in US dollars or euro and not in a currency of a country. The currency is not in demand, you can't use it, nobody accepts it. So these are the hard currencies. The ones in demand in the world economic system, the ones which are hoarded by the governments, central banks, and corporates, and even high net worth individuals. They are foreign currencies that run the global financial system. They are the hard currencies. We need the hard currencies. Why do we need the hard currencies? We need to import. We need to import because no country is self-sufficient. We import our petroleum, the crude that we import, we refine and re-export. So for our imports, we require foreign currency, and we also require foreign currency because we want to travel abroad. For that we require foreign currency, and we require foreign currency also because we have to pay back the loans we have taken. For all this we require foreign currency. And how do we get foreign currency? There are multiple channels. We export, and our exports are paid for in dollar, and that is kept by the RBI for a rainy day, for stabilization like it's today. Also, we have so many, about 20 million Indians abroad. They are NRIs, non-resident Indians, and they send a lot of money here. $155 billion last fiscal year. So remittances fetch you foreign currency. You have exports fetching you foreign currency. You have foreign portfolio investors investing in our stock market and bond market. That also gets you so much of foreign currency. Foreign direct investment comes into the country. That is for manufacture of goods and services. That is, they come here to set up their plants, set up their factories, set up their banks and so on. All that fetches you foreign currency. So there are channels of earning foreign currency, there are channels to borrow foreign currency, and there are channels for expanding your foreign currency, for example, your imports. So foreign currency is so important. Today means 10th of July 2026, RBI has $675 billion worth of Forex reserves. Now I need to differentiate for you the foreign currency and the Forex reserves. In the foreign exchange reserves of 675, bulk of it, about 500 plus, would be your foreign currency. And we hold in US dollar. We are diversifying, of course. US dollar, euro, pound, yuan, yen, and Swiss mark. These are the foreign currency units in which we stock our reserves. And what else adds to the foreign currency as far as the Forex concept goes? Gold. of late all the central banks they're afraid of the dollar. They're de-dollarizing because the American economy is not as strong and stable as it used to be, and there are huge headwinds for them. So all the central banks feverishly, relentlessly are acquiring gold, and thus you have gold exceeding $100 billion in your stock today. And then you got the IMF accounting unit, SDRs, that is special drawing rights. And then you stock up a few SDRs of your own, be it dollar SDR, whatever foreign currency, with IMF, and if you are in desperate trouble, you could draw that down. These are the four big elements that make up the Forex reserves, in which foreign currency is only one component. So that is, what is foreign currency? How do we get it? What do we need it for? And so on. Now, can we say the current phase in our external account is a bit of a pressured situation? Yes, of course. You remember, 13 years back today, in 2013, when American monetary policy was changing, interest rates there were getting better, and money was flowing out of India, and America was not printing so much of money, and therefore there was not so much of money to come into the country, and therefore it is called taper tantrum. They were tapering their quantitative easing. They were not printing anymore, so there was not so much of money in America that could come to India and other emerging markets, and therefore our rupee was depreciating. There is no demand for rupee. If dollars come into the country, there is demand for rupee, and the rupee appreciates. When dollars don't come into the country, the rupee depreciates. There is no demand for the rupee, and therefore the rupee depreciates. And so we called it taper tantrum because we didn't like it. We threw tantrums because they were tapering the printing of dollar. And that is why it is called taper tantrum. And that is when the RBI launched a series of measures to stabilize the rupee. All that the RBI did in the first week of June, in the current calendar, the RBI did then also. In fact, that had become the playbook to stabilize the rupee. We were well stocked, but then rupee was under pressure. And when you have a lot of Forex, but still when the rupee is under pressure, and when your imports are about $1 trillion, about $1 trillion worth of imports, you have almost $1 trillion, 950 billion or so. You need to be worried about it also for other reasons. Are we under pressure? External account? Yes, of course we are under pressure. Why? Our trade deficit, merchandise goods, is about $350 billion. We are making up because you got $155 billion worth of remittances by NRIs and PIOs and others, and you've got service exports of about $425 billion, and that is giving you some stability and relief, but the geopolitical, geo-economic pressures are mounting, and you see that reflected in the value of the rupee towards the dollar, which today is 96 rupees 29 paisa, and not far from 100, not far from 100. The way things are developing, West Asia, the geopolitics of it, and sanctions on Russia, the geo-economics of it. And also, you see, we are not doing too well on the stock market because globally stock markets are driven by artificial intelligence. Open AI, SpaceX, Nvidia, Apple, Alphabet, and so on. And of course, your Anthropic and your Open AI are coming up for the IPO. So the world is completely insane on the AI, and we have no bets on the AI. Therefore, the money from India is going out. The money from outside is not coming in. Stock markets are stagnant or falling. And that means that the external account is under pressure because FPI money is not coming. In fact, it is going from India. So FPI dwindling. FDI, there is negative pressure on the FDI. The net FDI is negative because a lot of these foreign direct investors are repatriating their profits repatriating royalty, and many Indian companies are also going out to buy the foreign companies, invest abroad. So there is negative FDI, and FPI is under severe pressure. There is external account pressure in the form of imports are going to be very costly because oil jumped, as you had seen, from 70 something to about 120, came back to 70 something. Now we are back above 90. It could touch 100 very soon because the Iran, Israel, America, the war is not ending anytime soon. It's getting more and more serious. So geopolitics, geoeconomics, FPI, FDI pressures, all of them are adding up to a lot of impact, negative impact on our external account. And therefore, RBI had about $700 billion or so, a little more worth of Forex reserves. But that's not enough. I just told you our external debt is about, $700-800 billion. External debt means both sovereign debt as well as corporate debt. The dollars that we borrowed from the global markets, offshore markets. So 675 is certainly not enough. And in that, the gold component, we don't sell gold. We never sell gold. Remember, the other day there was a report in the Bloomberg that Indian government, RBI sold gold, and then RBI rebutted them, refuted them, and they had to nearly apologize, backtrack on the report that RBI sold gold. We don't sell gold. And so you need to do something to stabilize. Structural reforms can always come about in good time, but stability is here and now. So in the first week of June 2026, RBI came out with a set of reforms so that foreign money could flood in. Essentially, the reforms centered around three dimensions. One, helping banks to get more NRI dollar deposits. Another, helping India's government companies to go out and borrow. And any risk is there, RBI will handle it. Still another is about foreign portfolio investors to find Indian stock market, bond market attractive, government bond market attractive, and the government has done certain reforms in these three areas. Now let us talk about each one of them in relative detail for UPSC. We don't go into so much detail in UPSC because this is not finance. This is not MBA finance. This is not external finance. This is the macro economy of India and the external sector, the place it occupies. So we need to optimize for the UPSC. And if I can trigger your interest, you can pursue in greater depth once the lecture is over. You have conversational bots for that, and they'll help you enormously. Yes, let's get started with the FPI reforms, foreign portfolio investor reforms. I told you the FPI is coming to the country with dollars. Dollar is a synonym for hard global currency. They come to the country with dollars, and these dollars are invested either in stocks or in bonds. The bonds can be sovereign bonds of the government of India or the corporate bonds. That is, the corporate bonds, companies, Adani's, Bajaj, NTPC, whatever it is, corporate bonds. So bonds and shares are the financial instruments bought by the FPI. How to get more of that? We are not into AI. They won't come otherwise, and they're leaving India and going to South Korea, Japan, they're going to Taiwan, they're going to Hong Kong, of course they're going to America. The Magnificent Seven, NVIDIA, etc. How to bring them into the country, the FPIs? You can do one thing. Till yesterday, there was a limit on how much a single fund could invest in government bonds. The RBI is floating a bond. Let's say 10-year sovereign bond, government security. And a certain pension fund could invest only 10 to 15% in that. Out of, let us say, $2 billion, they could invest only 10 to 15%. RBI said, go out and invest as much as you want. There are no limits. And they may be interested. We have excellent companies in the country. They may be interested. That fetches you more foreign currency. They'll say you are a little bit problematic still. Then we have told them, you please come, invest, we're going to pay you interest. That interest is tax free. And if you make 10% money from 100 rupees to 110, that is the capital gains of 10 rupees. On the capital gains, there is no tax. Capital gains, not taxed. Interest, not taxed. Come to whatever extent you are ready. There are no limits. This is how the Government of India debt is made attractive to the FPIs. And FPIs will come. Of course, there is a window. It's going to be open only till a certain time, by when we expect a lot of foreign money, and by then the situation could also improve and the external account could also consolidate. So this is a short-term window open to the FPIs so that India gets foreign currency from outside. This will help the RBI accumulate foreign currency. This will help the rupee not to depreciate or arrest the downfall. Appreciation may be ruled out, may not be desirable also according to a section of experts, but depreciation could be slowed or even arrested if FPIs see Indian bond market, government bond market attractive. That's as far as the FPI reforms go in order for them to come into the country in bigger numbers. Then let's see FCNRB account reforms. You know, Indian commercial banks operate two types of accounts for attracting NRI deposits. One is FCNRA, and that's in not so popular. It could be in rupees. In rupees is something else. FCNRA doesn't exist. FCNRB, foreign currency non-resident B account, that is where the dollar deposits of the NRIs are kept. They are not savings account. They are not current account. They are term deposits, for a few years, up to 5 years, 3 to 5 years. And RBI told the commercial banks, you offer them higher rate of interest. Now the problem is, okay, there is ABC Bank that has $100 from an NRI in the FCNRB account. That $100, the ABC Bank converts that into rupees and lends within the country. Or it keeps a few dollars and rest it converts. Converts means RBI comes and picks up those dollars for its Forex accumulation program. And the commercial bank keeps a few dollars because it lends in dollars also. There's an importer who wants to buy dollars, so you sell him. But bulk of it, you translate that into rupees and lend. Now, after 3 years, the NRI depositor comes knocking, sir, where is my money? Where is my interest? Which means that you have to give him an interest of about, say, 7-8%. Unless you give him so much, he won't come. And that is the global rate. It used to be called the LIBOR. I'm not going into that. That rate plus 300 basis points is what you are allowed to give, and you can give that much. He's given you $100. You have to return $107 to him. When he gave you the $100, it fetched to you 96 rupees 29 paisa per dollar. When you have to return the $106, that is interest included, you're going to convert how many rupees into a single dollar? No prizes for guessing. It could be at least 100. At least 100. Which means you're getting 96 odd and you are shelling 100. 4 rupees is your loss. RBI said, don't worry. This exchange rate risk I will handle. You don't have to bear. Bank said, fine, we are ready. RBI also told them the SLR and the CRR obligation on these FCNRB deposits in the current June 2026 program, you don't have any obligations. For example, the 18% of the deposit you need to keep aside for certain pre-directed investment like foreign, like Government of India bonds, etc. You don't have to. You want to buy the government bond, but you don't have to. CRR of 3%, that is keeping with the RBI, fetches you nothing, wasted money for you as far as the commercial operations are concerned. So the 18 plus 3, $21 converted into rupees. that much is available to you to lend as you want to the corporates, to the retail, to the Forex earners, whoever it is. So yes, CRR, SLR, and also the Forex exchange rate risk absorption by the RBI. All these attractive measures together have made banks go into the field with a lot of confidence. And today's Indian Express says already about $20 billion have come. And the expectation is that it's going to double up or triple up by the time the window closes by the end of the year. So FCNRB account could be a big success because right now, remember 1991, that was the worst any country could ever face. We just had $1 billion. You had to stabilize the rupee. And remember 2013, taper tantrum. Then we had foreign currency, but then we didn't have enough. We were under severe pressure. Raghuram Rajan, those days, the RBI governor, he created certain policy framework for stabilization. Now again we are into it for stabilization. This is not a time for structural reform. Everyone is trying to be above waters. The idea is not to be underwater. That is called stabilization. So on the FCNRB deposit front, there is stabilization. These measures help you get money. Yes, it could run the risk, but if you could somehow get the private sector in the country to consume the extra credit available, then it is a double bang for you. You get in foreign currency, you're also helping the domestic economy to rev up. And the third plank of the playbook of June 2026 is you have again given confidence to the ECB, external commercial borrowing. You know, government companies are there, NTPC, Power Grid, and so on and so forth, Coal India. If they want to borrow from outside, they are given certain confidence by RBI. Go out, borrow in dollars. Even banks have a policy that is called the Overseas Foreign Currency Borrowing, OFCB. They're essentially the same. What do? You borrow from a foreign source. You borrow at a certain rate of interest. You bring it home, convert that into rupees, do your business. Because if you are building a road in India, or if you are digging for coal in India, you don't spend in dollars, you spend in rupees. So you borrow in dollars, convert that into rupees. Where do you go to convert? RBI. And RBI adds that to its war chest. So if you have ECB, but then they are saying the same thing. Okay, I'm borrowing $200 million. I'm a corporate and I'm borrowing $200 million. Convert that at 96.29 as of today. And it's a 5-year loan. And after 5 years, I see rupee at 110. So what I get is 96 something. What I need to pay is 110. And how am I going to deal with such a massive gap? Am I to run into losses? Is it for profit for me or is it for country stabilization? Is it not loss for me? RBI said, you don't worry. We're going to pick up the exchange rate risk almost entirely. Which means you borrow. And in the Feb of 2026 also there were reforms. In that the limit was raised. A single company could borrow $1 billion. And the ones who could borrow, that is also expanded. Why they want to borrow, that's also liberalized. So ECB reforms have taken place in 2026 in 2 tranches, in Feb and in June. And in June what the RBI did was, I'll pick up the exchange rate risk, you borrow. And add to that the reforms in Feb of 2026. It is a serious package and that is paying off. Once again, Indian Express today. So on the ECB front, on the OFCB front, on the FPI front, on the FCNRB account, the term deposits front, On all these fronts, India is making its presence felt in the global financial markets, and we're going to survive. But then comes the challenge of structural reforms. We want the Chinese investment in the country. Why import from them when they could come and make here with all the accompanying advantages? And we're going to make it a good place to invest for the rest of the world also. We've got our deals with EU, Australia, New Zealand, UK, and we've got EFTA. So all these deals are going to pay off. We're going to earn foreign currency, and our economy is likely to boom. Everyone, as in India, as in the world, is waiting for the geopolitical tensions in West Asia to subside. And if we get lucky, the tensions in Ukraine also should subside. That is when the world will become normal. Then the big expectation is that protectionism should also recede and globalization, re-globalization should come about. That's about the Forex story, current account, etc., etc. And for you to have the entire picture in all the detail, here is the book you should continue to look to. This is the book. Wish you all the best.